All right, welcome back, everyone. Well, thanks for joining us for another Financial Autonomy podcast. We've got a fantastic guest in today, Brian Portnoy, and he's joining us from Chicago, which makes it extra exciting. Brian's written a really thoughtful book, a bit sort of Malcolm Gladwell-esque, about money and happiness. It's called The Geometry of Wealth. If anyone's catching a video of this, there's what it looks like, but we'll have a picture of it with the post on the website. Money and happiness, and a really this isn't a book about budgeting or what's an ETF or those type of things. It's got a lot more thought to it than that. And I've been working my way through it the last few weeks and really enjoyed it. Really got a lot out of it. So very much looking forward to digging a bit deeper with Brian. So firstly, welcome, Brian, and thanks for joining us.
It's my pleasure. Thanks for having me.
Now, I know you're in Chicago, and I have to confess I've never been to Chicago, and I suspect most of our audience probably hasn't either. My first thoughts of Chicago, I think Blues Brothers. Now, I don't know, is it correct that Blues Brothers were filmed in Chicago, or have I got that totally wrong?
No, you have that correct.
Blues Brothers, and then I think, Chicago Bulls and Michael Jordan, right? So what else, Chicago? Why should we come and visit Chicago?
Small town of 9 million people. Friendliest, cleanest big city in America. Beautiful parks, world-class architecture. Outside of probably New York, the best eating city in America. The restaurants are fantastic. And being in the middle of the country, it's a 2-hour flight to New York. It's a close to 4-hour flight to Los Angeles from here. You definitely get a very different cultural vibe than you do on the coast. So if you want to sample a different America, Chicago's the place to do it. I think it's the best big city in the country. I'm biased.
That's a great intro, great tip. All right, well, hopefully I get to visit one day.
All right.
So let's dive in. So the book, The Geometry of Wealth, I guess firstly, just from the name, I mean, it sounds like a book for maths nerds. What's the go there?
Well, I'm a nerd, always have been, very proud, always sat in the front row of every class I've ever taken. I'm that guy. But no, I'm not a math guy, and this is not a math book. The short of it is that pictures are better than words when it comes to learning, and I wanted to use some very basic shapes to help summarize the path toward true wealth. And the circle, triangle, and square represent the 3 steps. We'll get into what each of those means. But to me, the fun part, and the feedback's been nice, is that if you can remember the 3 shapes, you almost don't even need to read all 53,000 words of the book. You can, remember the thesis pretty quickly.
Yeah, very good. Clever. So, I mean, I can tell from reading the book and all the references at the back and that sort of stuff that, you haven't knocked this out in an afternoon or a few weeks. So what led you to write this?
Yeah, the book has, both professional and personal motivations. Professionally, I wanted to write a book that connected the big picture to the details of money and investing and financial planning. I mean, there are thousands, tens of thousands of books on investing, on money, on stock picking and risk management and portfolios and asset allocation and all that stuff that I think is actually quite boring. And people tend to gravitate toward those level of details. And then elsewhere in the world, there's bigger picture thinking, more maybe in a personal growth direction, even a self-help direction about what is a life well lived. I'd actually never seen a great book that connected the two. And one of the things I've noticed is that in the world of money, people can get really sucked into the weeds without really understanding what they're even doing this for. And on the flip side, those who, want to engage in the contemplative walk in the woods and ask what life is all about, they aren't particularly knowledgeable about how money can fund or needs to fund some elements of that journey. So my goal was really to try to create a story or a narrative that brought them together.
Yeah, and look, I got that from the book, so congratulations. I think you achieved the goal there for sure.
Thanks, man.
A central, just to sort of get into some of the detail now, I guess the central element that you had through the book was this idea of adaptive simplicity, and that flowed all through the book. You describe it as the engine to move us forward. Can you perhaps, I found it a bit of a sort of a slippery concept, really. Can you just explain that a little bit for everyone?
Yeah. So, like I made this up. It helped me kind of bring together some of these pieces that I was putting into place. So two words, adaptive simplicity, adapt and simplify. We live in a noisy world. We're dealing with more information, more data, more choice than at any point before in recorded human history. It's not clear at all that the brain is wired to process this much stuff. And so I think going from noisy and complicated to simple is super important. So cutting through the noise. And at the same time, as we push along in that journey, and there's a bit of a stone of Sisyphus where you simplify the world, but then things get noisy again. So you're never done. You're always going to have to kind of keep climbing up that mountain and push forward. So there's sort of an adaptive element to it. So as we go through the steps toward true wealth that I talk about in terms of purpose and priorities and decisions, this mindset of having control, recognizing what you don't have control over, recognizing what you do have control over, and appreciating that rolling with the punches and cutting through the noise is what you're doing at every step along the way.
Very good. All right, that makes a lot of sense, and certainly
is that better?
Good, yeah, no, good advice. Yeah, no, I understand. And so, yeah, I mean, a lot of the book, really, I guess the purpose of the book is about happiness and putting together money and happiness, and funded contentment is the way you describe it, which I really liked. Well, I guess you sort of explained earlier, but what really drove you to that, trying to understand happiness and thinking about happiness and that funded contentment concept? What was the trigger there, I suppose, for you?
Yeah, I mentioned just a moment ago, professional and personal motivations for the book. On the personal side, as I grow older, I've got 3 teenage kids and a wife, and we're making our way in the world. The 5 of us, at every step along the way, we're trying to figure out where happiness comes from, and not just in the day-to-day sense of pleasure versus pain, but really understanding the underlying sources of meaning and having that sense of fulfillment and contentment. So I personally wanted to explore that. That was meaningful to me. But then, one of my observations is that money is one of the most annoying and frustrating topics around. It's stressful, it's complicated, it's something that no one likes to talk about. Husband and wife, parents and children, coworkers, best friends. It's really not something that we are comfortable dealing with. But it's inescapable, right? Like it just seeps into the pores of everyday life. So how can we think about those broader frames on contentment or fulfillment, but then fully ignore what's necessary to kind of keep things moving on a daily basis, which always, unfortunately, does implicate money. So I wanted to kind of connect that all in a narrative that first and foremost was meaningful to me, and then hopefully meaningful to my community.
Yeah. And in that happiness element, you have the 4 C's. Do you want to just take us through that piece? Because I thought that was really important.
Yeah. So, one thing I tried to do was survey some pretty broad perspectives and disciplines and literatures on the topic of happiness. I mean, if you go to the thesaurus, there's 20 or 25 words that we can use to substitute for happiness. And it's just sort of a semantic disaster, really trying to define what that means. And I kind of think of it, from a simplified perspective, is that on the one hand, we've got, sort of the day-to-day pleasure versus pain, good mood versus bad mood, happy versus sad. And then at the other end, there's that deeper sense of joy or contentment or fulfillment. And that's mostly what the book is focused on. And if you survey philosophy, religion, literature, sociology, psychology, economics, and across the board, I saw there being basically 4 deep sources of contentment. And I'm going to quickly kind of, enumerate them.
Yeah.
And it's going to sound like a kind of a clean taxonomy, but it's not, because they overlap and they bleed into each other. And in some cases, they can reinforce or undermine each other. The first one is and just from a mnemonic point of view, I said the 4 C's: connection, control, context, and competence. So connection reflects the idea that we are deeply in our genetic wiring, social animals. That's part of our survival instinct. We want to have connections with our community. 2, we want to have control over our lives. We want to have that sense of autonomy, just not in the physical sense, but also in the broader sense of being able to tell our own story about ourselves. And so what you see in philosophy and literature and religion are so many stories about people who have been physically imprisoned, but then, with their mind, they're able to find liberation in the ideas that the jailer has not been able to take away from them. Thankfully, most of us aren't in that situation, but we're all under duress in some way. And so we want to have control over our own story. The 4th C is competence, which is basically being good at something that's meaningful to you. Finding flow in your job, your vocation, or the hobbies that you really care about. At least in America, the first thing that somebody asks you, either in a business meeting or at a cocktail party, is, what do you do? It's just part of our identity, right?
Yeah.
And then the 4th C is context, which I think is the broadest and probably the most amorphous of the 4. And that's the idea that we want to be connected to something outside of ourselves, a belief, a cause, a community. And as I mentioned, these 4 interplay with each other. What I've tried to do in my personal life as I've come up with this framework is to appreciate that, and sort of thinking through my own personal history, I'm in my late 40s, is to appreciate that at various points in my life, going back to my earliest memories as a boy, different things mattered in different ways. Sometimes it was more about having control. Other times it was really about that connection with family or community. Other times it was about work. And so I wanted to give folks a workable, but, I think imperfect taxonomy to think about what they're really trying to do in life.
And then with that framework in mind, would you envisage, people are thinking around, well, what's going to make me happy, or, I'm not happy and how could I be happy, or thinking into the future, what's going to make me happy, and then think around those and try and sort of get a tick in each box? Or like you say, is it a case of, well, if I can satisfy one of these, I'm good to go? Or how are you sort of thinking about that in the practical application of it?
Yeah, I think it's a little bit dangerous to think of this algorithmically, in the sense that you've got 4 columns and each can go from 0 to 10 and the max score is 40. Like, we can imagine building an app based on this. And man, if you can max out all 4, then like you're super cool. You're basically the Buddha, right? Like, you got it. And if you're, 0s or 1s or 2s, I think that's too clever by half. I kind of use it as a guidepost. Well, first, a vocabulary, sort of a set of words and concepts that we can at least start with, and then begin to think that we can't do it all at all times. We can't have all sources of contentment maxed out at all times, but we can think about these things. And as it relates, as to connect to the financial planning process, realize that in a variety of ways, sometimes strangely, sometimes frustratingly, sometimes constructively, each of those deeper sources of contentment does require funding. It requires that we underwrite a happiness, or try to, afford a meaningful life. So that's sort of the difficult part. It's less about, if you have a max score of 40, saying, hey, over a sum total of 33, you're really, really happy. It doesn't really work that way.
Very good. Understood.
Yeah.
So let's dive into the money and investment element then. So,
yeah.
Well, actually, hang on. Before we do that, so
Sure.
The geometry of wealth, we've got the 3 symbols: the circle, the triangle, the square. Do you want to just perhaps talk us through what those 3 are and the step across there?
Absolutely. So let's start with the biggest definition of the book, which is understanding wealth as the ability to underwrite a meaningful life. Okay.
Good.
So I contrast it to being rich, which is more, or the quest for more money, or the things that money buys. And in wealthy societies, and I see it certainly in American society, that push to be rich, it can be all consuming. And we know from psychology and now neuroscience that sprint toward more does not make us happier on a day-to-day basis. So I'm trying to tap into the deeper sources of contentment. So wealth is funded contentment. Well, okay, I could say it, but then how do we get there? And to me, there's 3 steps. And again, it's not super clean, and it doesn't happen just once where you execute 1, 2, 3. This is sort of going around and around in life, this notion of adaptive simplicity, right? Because we're rolling with the punches, and, entropy in life is everywhere. Things just get messy. You clean up your closet at home, and 2 weeks later you look in, it's like, well, how did this become a mess again? That's our lives in a nutshell. So the 3 steps: we want to think about our purpose. And I've suggested the 4 sources of that deeper underlying sense of what we're trying to accomplish. We then want to set broad priorities, broad financial priorities. And by virtue of having a triangle, I use that to symbolize that there are 3 quickly. One is to manage risk. The second is to have a really rock solid balance sheet, what I call matching. Match up what you own versus what you owe. If you have that solid balance sheet, then you're probably going to be in pretty good shape. I know lots of rich people who don't have a family balance sheet, and they're not really in control of their lives because they don't know. And then that third priority, I call reach or aspiration, where you've thought about managing risk, just not in your portfolio, but across your career and your relationships in a more broad sense. And then you have the own versus what you owe balance. And then you can kind of reach to stoke those 4 C's even more. All right, so we've gone from purpose to priorities. Once you've established those broad priorities, you are then going to have to get in the weeds. Make very specific tactical investment decisions. The key to being a successful investor is actually managing expectations well. People like to frame it in terms of beating the market, or choosing the next hot investment, or finding the new hot fund manager. I've been in this world for 20 years. I would stridently claim that those aren't the right ways to think about it. We should think about it in terms of expectations. And I put out through the square 4 corners, 4 sides, 4 elements of that expectations formation process that we really need to go through so that we can either make good decisions, or I think in an even better context, we're working with a money coach or a financial advisor, and those 4 key pillars, or those 4 corners of the square, can help manage the conversation between advisor and client. Because in my day job, I see how that conversation between advisor and client can fall down in a lot of different ways.
And that, yeah, I want to get into that a little bit, because there's a few different elements there around probabilities that you talk about, the difficulty that we all have with buy and hold strategies, and just leaving things alone. You talk about, in terms of good investment outcomes, key drivers around behavior, portfolio parts, in terms of the prioritization of those. Can you just maybe talk us through a little bit about that?
Yeah, I think something that anybody in their money life, not just their portfolios, but their savings behavior and spending behavior, and how they manage their career, we have to appreciate that success comes not from getting things technically right, but appreciating that it's our own behavior and our own decisions that are the ultimate drivers of success. So behavioral finance is the field that I work in. You certainly are very familiar with this. Some of your viewers and listeners, might be familiar with Kahneman and Tversky and Richard Thaler and the sort of the big guys who invented this field that sort of introduced psychology into economic and financial decision making. If you look at sort of what matters as it relates to our financial decisions, I think the evidence strongly shows that it's controlling our own emotions or outsourcing difficult decisions into a process where we're not going to really screw things up at the worst possible moment. You think about Ulysses and the mast, and really in one way or another tying yourself to the mast so that you can resist the siren song of the market, because when the market turns down, there's a survival instinct that kicks in, and it's usually not very healthy. Frequently in our business, we think about investment success in terms of the portfolios we build, and even more so in terms of the hot stock or fund that we see on financial television or in the newspaper or from our neighbor across the way. I think it's important to flip the script and say those pieces of the puzzle, the stocks and the bonds and the funds, less important than the portfolio we build in terms of broad allocation to stocks versus fixed income versus cash and real estate. And that in itself is much less important than the behavior that we manage. So I think we want to level set on the fact that the key to financial success is not beating the market, it's controlling ourselves.
Yeah, spot on. And that the element of the portfolio piece, which is, as you say, it's around asset allocation, and I'm pretty sure it's in your book, but certainly it's, I've come across it plenty, that in terms of the explainer of performance across different portfolios, and I think usually they do it on balance funds, but about 90% of a portfolio's performance is explained by its asset allocation, and the remaining 10% is split between trading, market timing type stuff, and which stocks you pick, right? So those two factors, 10%. That's in terms of the explanation of performance. So yeah, certainly it really is all about asset allocation is where you want to focus your energy, and certainly that's
when it comes to technical investment expertise, asset allocation trumps security selection. And in my prioritization of individual positions are less important than the asset allocation, and then the asset allocation is less important than your behavior over time. I'm not saying that the parts and then the overall portfolio are unimportant. Quite the contrary. I'm just saying that, we have limited time and limited mental energy, and we should focus on what are over time the really important drivers, and trying to identify the next Amazon is less important than anticipating that during a bear market, we're probably going to want to make some bad decisions, and we should put ourselves in a better spot to navigate that down the road.
Which ties into the concept that you mentioned about it's more important to be less wrong than to be right. So avoid those big missteps is far more important than, as you say, trying to get lucky pulling a particular stock that happens to go through the roof. Yeah,
we don't pay enough attention to the idea that much of what we should be trying to accomplish is minimizing regret as distinct from maximizing gain. So people like that idea once you introduce it to them, but my experience as a speaker meeting literally thousands of investors every year, they hadn't really thought about it that explicitly. But the fact is that, in our types of societies, we want to be faster, stronger, better. We want to be more right. We want to accomplish. We want to be better than ourselves from yesterday, but we also want to be better than our neighbors and our friends and so forth. We're naturally competitive, and that's a natural thing and a good thing. But when it comes to investing, we want to also not just be more right, we want to be less wrong, because that ability to minimize future regret is so, from a neurological point of view, so closely tied to that ability to feel deeper forms of contentment. We want to take it quite seriously, and introducing regret minimization into the financial planning process is something that's coming around. But most of investment theory, let alone self-help, pie in the sky stuff, isn't very explicit about that.
No, that's quite right. I mean, I certainly can't think of, the different presentations and bits and pieces, that I attend. That's certainly not usually the cornerstone of the conversation by any stretch. No. You're on the money. Hey, I wanted to, there was a quote or a sentence in the book that I wanted to explore with you, and it was around the subject of probabilities and the fact that as humans, we're not naturally very good at thinking in terms of probabilities. And you had in there Investing is far less precise an exercise than most think, which means that with a bit of preparation, ending up in the right spot is more achievable than many suppose. Now, the first bit, investing is far less precise an exercise than most think, but then on the flip side, you're saying with a bit of preparation, it's easier to get to the right spot. That sentence felt like a bit of a contrast or a juxtaposition. Can you flesh that out a little for me?
Yeah, absolutely. So what I'm saying there, what the first part is that, when we think about investing per se, so now we're talking about picking stocks and bonds and building portfolios, it's a very, it comes across as a very precise science, right? So the way that we consume financial information, we see numbers with one or two or even more numbers to the right of the decimal place. When we look at reports that compliance requires us to show, we see a lot of precise numbers, and we are socialized to believe that there's a right answer. It's almost seen as an engineering problem. It's one of the reasons I've seen across my work that engineers actually tend to be quite difficult clients for financial planners, because engineers, they better have the right answer or that bridge or that building collapses. So when their financial planner has built a portfolio, they think, okay, there's one right specification here, and if we don't nail it, it's all going to fall down. That's not actually true. We fetishize the numbers, but in fact, as long as we're sort of moving into the right direction and create sort of not a narrow bullseye, but a large field, and you're throwing in the right direction, the preparation comes, all right, do I want to throw in this direction or do I want to throw in that direction? It's not, do I want to hit a tiny bullseye? Once you figure out which way you want to go, then it's not that hard to throw the dart or the ball or the spear into the right field. So that's what I mean. Yeah. Understand what the game is. You might recall from the book, there was a brief, but I think telling anecdote from Harry Markowitz, who in the 1950s invented portfolio theory. He was the guy that put the numbers behind diversification and why portfolio diversification is so important. And, he's legendary, but there's this true story about, he was interviewed by somebody and said, okay, how do you build your portfolio in light of these incredibly precise scientific techniques? And he said, when it comes to my own stuff, I just do 50% stocks and 50% bonds, because if the market goes up a ton, I want to be able to keep up a bit. And if it goes down a lot, I don't want to lose everything. Yeah. Think about that. The inventor of the science of portfolio building, he basically wanted to be less wrong. Yeah, he wanted to be less wrong. So I think we can follow his lead.
Yeah, no, I do recall that. And that was, a point well made there, I thought. Yeah, well done. So, and I guess tying in, we talked about the behavioral aspects and how important that was. And I mentioned earlier, inherent in that is the benefit of just buy and hold and leave things alone. And, of course, we saw in 2008, it was a particularly difficult time, markets tanked. And, certainly I know in terms of the clients that I worked with, you had a lot of people, worried and, gee, should we be doing something? There was a sense that we should be, surely there's got to be something we've got to do here. The world's coming to an end, right? It's never going to be the same again, and there's a sense that you've got to do something. But, all the evidence suggests that actually the best response will be to do nothing, right? But it's very hard. Have you got any advice or thoughts on, how to calibrate that, how to make that work in the best interest of investors?
A ton, because this is probably the number one topic that I counsel advisors and investors on. First of all, we need to give ourselves a little bit of a break. So I think the most dangerous word in our industry is irrational. It's quite pejorative, another word is emotional. You're just being too irrational. You're being too emotional. I like to go a different direction and say, well, you're actually just being so normal and you're being so human. Your brain evolved 150,000 years ago in a very different context, and to solve problems having nothing to do with fast-moving capital markets. So let's appreciate kind of what we're up against and recognize that we're very normal. When we feel danger, that sense of kind of the long-term collapses. Okay, so we're here and now, and the market goes down. It seems like our money is disappearing, and we feel scared. Okay, and when we feel scared, we want to run. That is the most natural of instincts, really going back more than 100,000 years. So when we give the advice of don't just do something, stand there, it feels really hard, and it is really hard to abide by. I think one of the reasons I've become such a strong advocate for money coaches or financial advisors for people all over is that it's really good to have somebody who's not yourself, not your partner, not your best friend, but a somewhat objective professional who can say, this is the plan we're on, and in the throes of the heat of battle can say, this would be the bad move. This is not the right thing to do. There's got to be trust built up before that for them to take your advice properly. Respectfully, a lot of people think that financial coaches or advisors, their expertise is in the market. They're going to find the new hot opportunity. The commodities industry hasn't been doing well, but it's going to kick up. Or this is where the Chinese economy is going, and this is how to play it. My view is very different, which is that people should look to their financial advisors as someone who can keep them from being the worst version of themselves at the worst possible time. The other thing to do, in terms of Ulysses and the mast and resisting the siren songs, is to automate decisions. So we know, at least in America, but I also believe in Australia, that when you are enrolled in an automatic savings program, you tend to have much better outcomes than those who have complete discretion. Because through thick and thin, whether you get your paycheck every week, 2 weeks, every month, whatever it is, a little bit goes into the pot, and you don't have to really think about it. And you're probably not going into your company's system, HR system, and jiggering everything on a weekly basis. It's just flowing along. So buy and hold sounds easy, but simple doesn't. Sounds simple, but simple doesn't mean easy. And the more we can recognize that we need help from others or reliance on good decision techniques, the more we can do that, the better we're going to end up.
Yeah, no, good advice. With the book is about, and what you're exploring is about, the link between money and happiness, and something that you touched on and that I've been speaking with a few people just in recent weeks was this idea around, the importance of goals, but that, for instance, you could have a goal that I want to buy a new car, right? Whatever that car might be, Ford Mustang, let's say, because that's going to relate across both countries, right? So your goal is, I want to get a Ford Mustang, and, you save or whatever, however you do that. And then you get there, you buy the car, and you feel fantastic and you love it. And it, it looks awesome, and, you can't wait to show it to your friends, but give it a month or so, and then, it's just my car and I need to get to work, right? The happiness that produces is real, but it's not especially lasting.
Yep.
And I think, you touched on it in the book. Certainly, as I say, it's come up in a few other conversations, that actually more of the happiness is making progress towards the goal. And maybe the car's a bad example, but, if you're, in fact, my wife gave an example, which isn't really finance related, but she was talking about weight loss. She said, when you're on a diet, you feel really good as you lose weight because it's great, I'm making progress. But then once you've lost the target weight, it can be hard to then maintain that because, again, you're not making any progress. You're just kind of staying where you are, That sort of, it's a bit counterintuitive, So for one, you need to have goals because that's an important element to work towards happiness. But in actual fact, the achievement of the goal is less important than the journey to get there. I just wondered on, your thoughts on that. Do you think we're sort of on the money there, or what? Yeah, how do you?
So that's totally spot on. So everything you just explained was precisely accurate and completely in line with, I think, the well substantiated conventional wisdom in social psychology. And I'll throw out a really clumsy term. It's not mine, but I use it all the time, which is the hedonic treadmill. This is the notion from psychologists that, we're walking toward happiness, but when you're on a treadmill, doesn't matter how fast you're walking or sprinting, you never get anywhere. Okay, so your car example is perfect, but your wife's example about diet and exercise is also very relevant. Um, we often equate, and the financial planning business, I think, is particularly bad at this, which is thinking that, well, if you achieve your goals, you're going to achieve, you're going to be happy. We tend to be very bad at predicting what makes us happy in the future, and to the extent that we know, buying a fancy new car, that's going to be cool. We'll be happy with that. We're even worse at predicting the duration and intensity of the happiness that we feel. It fades away. We're on that treadmill. One of the reasons I wanted to write the book was because associating goals with happiness tends to be happiness in that short-lived pain versus pleasure, good mood versus bad mood, as opposed to the more durable and deeper kind of sources of meaning that we talked about through connection and control and so forth. So I think not only individual investors, but financial advisors also, and I see this with the biggest financial planning firms in the world, they think meeting goals equals lasting happiness, and then they have dissatisfied clients and they wonder why. The biggest example is actually retirement, this idea that you get to age 62 or 65, whatever the number is, and you've sprinted through the finish line, the tape breaks, your financial planner gives you a high five, there's a big party for you, congratulating you on your success, and guess what? Within a day and within a couple days to a month of your retirement party, you're sitting around saying, what next?
Yeah.
And it's becoming a bigger and bigger problem because longevity in Western world, especially among people with more money, is increasing significantly. So before the expectation was you would pass in your 70s and then 80s, and now we're into our 90s and even beyond. So what does it mean to retire at age 62 or 65 and have 30 more years to go? Not only from a monthly income point of view, but from a what in the heck am I going to do with my life point of view. So that's why, this adaptive simplicity concept I come back to sometimes, because there's always noise, and so we got to cut to what really matters, but we have to give ourselves a break and recognize that we're constantly kind of figuring stuff out. The protagonist of the geometry of wealth is the adaptive self. It's appreciating that you don't know who you're going to be in the future, and where I think the most exciting research in both psychology and neurosciences as it relates to the world of money is attaching the current self to the future self. This is where advisors can do unbelievable work, where they help people imagine who they're going to be in the future and create contingencies and flexible plans, not just sort of a simple checklist, but contingencies for, hey, you're going to want to go in some different directions. I don't know, and you don't know, but let's talk through it. And we're going to check in from time to time, and we're going to update. I actually think that can be fun for people versus what most financial planning is for many people, which is kind of a headache.
Yeah, no, quite right. And I guess part of that is, and often when we're working with clients, structuring it rather than I want to retire at whatever the age is, structuring it as I want the option to be able to retire at 60,
Correct.
whatever, right? Because quite right, you just don't know when you get there. And as you say, a lot of, there's certainly a potential to feel quite lost, and
yeah. And if you revisit,
and just this traditional thinking around that, we have this working life of 40 odd years, and then we're just going to retire. And then we're going to have this in Australia, we often refer to it as the grey nomad period, that they get their caravan and they travel around Australia and all this sort of stuff. My parents are doing that right now. It's a very common aspiration. I'd imagine probably the US similar. But, why does it have to be that way? I mean, the concepts of mini retirement and I guess, enjoying the journey a bit more, and rather than a race to, well, gee, how young can I be? Retire, as you say, you're probably going to live into your 90s these days increasingly. So is there really a great rush? Maybe you'd be better off having a few breaks and doing a few things. Perhaps, you've got teenage kids as I do, perhaps enjoying some periods there. And if it means that you work until 70, that's far from a terrible outcome, so long as you have
Yeah.
got issues like control and that sort of stuff.
Man, you get it. You totally get it. Just a couple things, and just to amplify something you've said a couple times, the journey versus the destination. It's sort of a bumper sticker or poster material. Enjoy it's about the ride, not the destination. Without being maudlin or saccharine about it, the existing psychology and neuroscience does suggest it's about the ride. It's about the journey. It's really not about the destination, because when you get to the destination, you then ask, okay, well, where do we go now? Because we want to move forward. And the second thing, like if we come back to the 4 C's: connection, control, competence, and context. For a lot of people, especially men, competence is huge, being good at your job. And this idea that you're going to devote all of these years, 40 to 50 years, to becoming really good at something. And remember our cocktail party question: what do you do? It's our identity. It's our public identity. To then say, oh, okay, well, I've done really, really well at this for a long period of time. Guess what I'm going to do? I'm going to stop doing what gives me my deepest form of identity. It's kind of a crazy, when I put it that way, I think, well, it's kind of a crazy process. And so you do find retirees, especially men in the workplace, who really struggle. And you see studies of depression and loneliness in male retirees because of that.
And the other element that I think about, my grandfather, he was a carpenter, right? So when he retired, there are physical limitations on some of those kind of jobs. I mean, there's only so long you can, climb around on the roof and these sort of things, right?
Right.
Days gone by, retirement was necessary due to, physical limitations. But most of us these days, obviously, there's still plenty of people that do physical jobs, but for very many of us, like you and I, we sit at desks, right? I mean, so long as our mind is active, there's not really anything to stop us. And obviously, that particularly in medical professionals, my observation is they do tend to work on. It's not at all uncommon to have people in medicine working into their 70s. I think that's because it does, they do get a lot of satisfaction out of the job, and they feel like they're helping people. And so they continue to work. And again, it's because they're not limited by, physically being worn out. They just need to be mentally on their money, on their game. I think for a lot of us that applies. There really is no reason why you need to retire at 60 or 65. You're often, you got all this fantastic experience, and there's no reason why you couldn't continue in the workforce. But it's sort of something we've been conditioned to expect or to aspire to.
Yeah. Well, we're certainly, most of us, most of the time, including me, I'm trying to think through these things, but most of us are living by older scripts as to the way life should go. And I think we're seeing, because of technology and medicine and, other sources of change and innovation, that the old scripts are being sort of undermined or pushed aside for newer stories that we're going to tell about ourselves. The idea that mid-career you would take off a year and travel with your growing children, I think 10, let alone 20 or 30 years ago, people would have thought you're insane. And I think now people would look at you and say, geez, I'm so jealous. I wish I could do something like that.
Yeah, no, spot on. Hey, I noticed in the acknowledgements at the end, and yes, I did have a look at the acknowledgements. Probably
you learn a lot about authors from the acknowledgements.
But I noticed in there that you said that you expected that this would be your last book about money, and I know that, as you said, you're late 40s, same as me, so you got a lot of life ahead of you. But this is going to be your last book on money, which is obviously that's your game, right? So why do you say that, and what are you going to do next?
I think I wrote that. I don't regret writing that, but it has raised a lot of questions. It's not going to be my last book because, to what drives happiness in me, or that deeper source of joy. I love writing. When I'm at the keyboard and just sort of banging out ideas, and even if the writing is crappy, which it is most of the time until you have a chance to edit it, that's where I get my flow. So there's no question that I'll keep writing. There's just a bigger world out there. So I've now written 2 books on money. This one on, mapping up money and happiness and seeking true wealth. And then a second book on investment decision-making per se, from a behavioral finance point of view. And they sort of go together, and they cover the waterfront of many of the things I've learned over the last 20 years. But to me, I read a lot. I find the world to be just a fascinating place. I'm pretty curious about a lot of things. And, I had an academic career a long time ago, and I wrote and taught about global capitalism and big global trends and things like that. And, as the world is going through, its current form of convulsions, there might be some topics that I want to pick up. I just made the case in this most recent book that money's inescapable, so it probably can't go away entirely. But I do think that for now, I've left my best stuff on the field. I'm going to walk off to the next contest, and I'm going to see what I'm going to come up with. But this book came out like 5 weeks ago. I'm pretty exhausted. Plus, it's summer, so I'm not going to worry about it just yet.
Fair enough. Well, look, thank you, Brian. So the book again is The Geometry of Wealth. So I'd encourage people to check it out. Certainly I got a lot out of it. So look, thank you. I know, as you say, it's summer, you're probably on holidays. So thank you very much for giving some of your time. Where can people track you down, social media wise and that sort of stuff?
Yeah. So my Twitter account is @Brian Portnoy. So I tweet a lot and participate in a lot of conversations on behavioral finance and investment decision making and things like that. So connect with me there. Happy to chat with you. I have a personal website called shapingwealth.com, and that has links to the books and some other stuff about me. And then in terms of my professional gig, I work for an investment firm called Virtus, and at virtus.com, virtus.com. A lot of the investor education materials that I've helped to create for both advisors as well as regular folks, that's on there for people to peruse.
Fantastic. All right. Well, look, thank you once again, and look, thank you for writing the book. Thank you for your time this morning, and really enjoyed the conversation.
Yeah, me too. Thank you so much.
No worries, Brian. Bye-bye.
Yeah. Bye-bye.
Thanks for listening to the Financial Autonomy podcast. Please keep in mind that the information contained in this podcast is general in nature. Your financial needs, circumstances, and objectives are unique to you. Before embarking on any investment or financial strategy, you are strongly encouraged to obtain professional advice tailored specifically for you. Need some help reaching your financial autonomy goal? Visit the Work With Me page at financialautonomy.com.au to learn how Paul and the Financial Autonomy team can help you succeed.